Good morning, traders. This is TonyD from easyMarkets in Sydney. We have a little update over the weekend. You probably seen on Saturday morning that US stocks have finished at a record high. Surged another 200 points on Friday. Have opened up very strong here today. The move from 25 to 26,000 on the Dow seems to be happening in a very aggressive fashion. Without any sense of decent pullback yet in the last 3 or 4 months of trading, we are seeing some overbought levels that are getting close to historical levels in terms of all-time highs way back to the 30s. If you're looking at where it can go though in this sort of environment, it's very dangerous to try and sell until we have some sort of catalyst or some sort of a price action which will support that view. But from these levels, then just to pull back to the 200-day moving average, we're talking multiple thousands of points. It is an interesting market at the moment in terms of sentiment. It's super strong. Inflation picked up in the US on Friday, especially the core inflation. So there could be a year where we start to see inflation come through around the world. But the most important thing was that retail sales came in strong, and also the previous numbers were revised a lot higher. So the consumer over in the US is really driving this recovery at the moment, and seems to sentiment anyway be very strong, and the actual numbers on the ground be very strong. So we're seeing that come through with stock markets and earnings mostly beating here in the US. In terms of the US dollar though, the opposite. The US dollar is getting crushed. So inflation and high yields on the bonds is not a savior for the US dollar. We've seen the euro break 121. So it's fresh highs, broken through those 2017 highs. Really accelerated once we got that technical break on Friday. Now the main catalyst given on Friday was the announcement that looks like a deal will be done, a new grand coalition in Germany. So this really helps sentiment. And you're seeing the market and close near highs. That's a very bullish sign. So the next level up is 125. A lot of traders talking about 125 coming. Now, if you're talking about the US dollar, that would make sense, because the US dollar index, if you look at it, has broken a key support. So last year's low has been broken, and there's a bit of daylight here until we get to the next levels, right? So seeing the market 2014 rally from 80 all the way up to 100, and now we are on the way back down. There isn't really a technical support where the market's stabilized. So 90, while it's a big figure, can easily be broken if the trending continues. This is dragging down dollar yen, which usually does really well in a high yield, high stock market environment, but the decoupling between the yen and the US stocks and US bonds is pretty strong at the moment, so it's very hard to fight that. Price action is really dictating that we are going lower, and it's pretty dragged, kicking and screaming. Dollar yen though is being a little bit supported on euro yen, which has been strong in the last couple of days, bucking the pullback that we saw from the dollar yen led losses. So unless something changes here, it's very hard to see the market reversing. Gold, while stocks are super strong and inflation is picking up, not the best two combinations for gold. Gold is just thriving here on the weak US dollar. So it's not really the time to be looking at the market in sense of trying to fight these trends or looking at the old correlations. It's time to sit back and see this new trend, and definitely stick with that until told otherwise, because if the market changes correlations on you, you have to adapt to the new world. Yeah, and so the weak US dollar story seems to have legs in 2018 so far. Alright guys, if you want to have a quick update on what's going on, there's all pairs are in play right now, so you can call me on the number below. If you're not a member of the easyMarkets dealing room, please sign up below, and we can have a chat about your trading and the outlook for the week.